It's going to get worse as defaults are about to hit the major U.S. banks. I'm real Steve Van Metre, and thanks for joining me today. We continue to hear from the Federal Reserve that the economy is booming and only going to get stronger. Yet the major U.S. banks are suggesting otherwise as they prepare for a wave of defaults. Let's over to Wall Street Journal, where we picked today's story up as Citigroup's profit falls as it preps for potential loan losses. Preparations for potential bad loans in recession pushed Citigroup's second quarter profit down 20%, offsetting a boom in business from global companies trying to position themselves for rising interest rates. Results from the nation's big banks are showing that consumers and businesses remained healthy in the second quarter, but the banks are also flashing concern about the future of the economy given heightened uncertainty. And U.S. stocks have fallen sharply this year on concerns about a global slowdown, which has hurt bank shares in particular. The Federal Reserve is raising interest rates aggressively, trying to combat inflation, but many investors worry that it will tip the economy into a recession. And now, all of a sudden, we're about to see why this matters. Why do bank stocks matter to the broad equity market? Because right now, investors are really bullish, but they perhaps shouldn't be, because the banks are starting to warn them that things are potentially going to get worse. And if there's anyone out there that knows the position and health of the consumer from a financial standpoint, it's the banks. Because when we look at, of course, bank stocks, here we have the largest traded ETF in the financial sector, XLF, here in the red and green color, and I've overlaid the S&P 500 here in purple. And notably, as bank stocks go down, which they would because the economy gets worse and profits are going to get worse, and they're concerned about defaults, well, that's bad news for the broad equity market. And the economy is sending divergent signals about its health. Consumers and businesses remain financially strong for the most part, but bank executives across the industry said this week that there remains more uncertainty than normal about where the economy is headed. And while sentiment has shifted, well, a lot, a little of the data I see tells me that the U.S. is on the cusp of a recession, according to Citigroup's chief executive, Jane Fraser, said, pointing to consumer balance sheets, strong hiring markets, and corporate demand. So while a recession could indeed take place over the next 2 years in the U.S., it's highly unlikely to be as sharp as a downturn as others in recent memories. And well, that is probably not the case, because when you look at the history of the Fed, and when it tightens monetary policy is particularly aggressive as it's doing now, well, there's a 90% chance that it's going to cause a deep recession. Only 10% of the time does the Fed pull off a soft landing, and those times it does, well, shortly thereafter, we head off down into the plunging recession that we're so used to. So the notion that we're going to escape this, of course, with the Fed planning even more hikes, highly unlikely. The banks set aside an extra $375 million in new funds for potential future loan losses as Citigroup is concerned about a wave of defaults that could be beginning. And that hurt earnings. A year ago, with the global economy emerging from a pandemic slump, Citigroup released $2.4 billion from its reserves. And I want you to understand that these reserves that they're buying bonds in the case, if they need this, liquidate them, of course, to pay against claims of defaulted loans. And so when banks are doing well, they release their loan loss reserves out, and that drives their stock price up. So as they start to build, and I want you to watch, and we'll keep an eye on this in the quarters to come, as banks increase their loan loss reserves, that means their profits are going down, their stock price is going down, and that is bad news for the broad equity market. JP Morgan Chase, which reported Thursday, also said it was setting aside new funds for potential bad loans, as Citigroup said it was pausing its stock repurchase partly because of the uncertainty. And of course, think about what now we have two banks saying they're pausing. Of course, we'll see how long that lasts. It may go even longer. Their share repurchase plans. So what does that mean for bank stocks? Are they likely to go up or down? Of course, without share repurchases, that means they're more likely to head lower, as they are the biggest buyer of their own stock. Last month's Fed stress test gave the biggest U.S. banks a clean bill of health, but many will be required to hold more capital in the coming months. Capital meaning they've got to buy more bonds. and we want to get a more stable environment and get close to those capital levels, said the CEO, Mark Mason, of the buyback halt. Consumers continue spending and borrowing in the quarter as consumer spending on city-issued credit cards rose 16% in the quarter and balances increased. Spending on commercial credit cards was up a whopping 61%. And this is normal in a late cycle. What you tend to see is, of course, people tap credit because they can't keep up with inflation. And those who know that they're not going to be able to, well, hey, if the banks are doling out loans, you might as well get one, because there's going to be a point where the banks, if they keep increasing their loan loss reserves, won't be lending. Now let's continue on, because now let's look at Wells Fargo, who also reported earnings, and this headline is "Market Downturn Weighs on Wells Fargo's Profit." And Wells Fargo's profit fell whopping 48%, weighed down by a decline in the value of his equity investments and a drop in mortgage originations. And mortgage originations fell 36%, crimped by higher interest rates. And that's something we've talked about on the show, that these banks that rely on these big mortgage loans, these big profitable loans, well, as they collapse and demand falls, it's going to have a major impact on their profits. And guess what in turn? Of course, you've got it, their stock price. The bank said it set aside $235 million in new funds to cover potential losses because of loan growth it experienced during the quarter. A year ago, the bank released a whopping $1.64 billion in funds it set aside for potential loan losses. And auto loan originations also decreased 35% as revenue from credit cards and personal loans increased 7% from a year ago. So again, this is completely normal. You start to see, of course, refinance applications fall, demand for housing fall, demand for cars fall. As revolving credit increases, you're seeing the banks start to increase their loan loss reserves as a major warning that perhaps the economy isn't as great as everybody thinks. But if you're concerned what it means to your portfolio as bank stocks could head lower and, of course, the equity market fall with it, well, there's one strategy that knows that if bank stocks go down, guess what falls too? Interest rates, and it hedges with bonds that go up when interest rates fall. That's Portfolio Shield. I'll put a link up here in the corner and a description below. Let's continue on, because things now from Bank of America say, well, they don't think this is going to be a deep landing of the economy. They think, well, we're just going to have a nice soft landing. But is B of A right? No, I don't think so. A mild recession ahead as B of A altered their outlook for the U.S. economy to include a mild recession later this year. Consumer and producer prices in June surprised to the upside, suggesting underlying price pressures remain firm. While a 100 basis point hike at the July FOMC meeting is a possibility, they're going with the Fed's 75 basis point increase. Certainly not a 75% increase. That would be one for the record books. But let's challenge this B of A notion that we're going to have a soft landing, because the equity market is telling us that things in the unemployment space are about to shoot higher. And here we can see the 4-week moving average of initial claims against the Wilshire 5000 price index. Now, I did put the moving claims on a log scale just so we can fit it here and see it. But notice that these things have a near mirror inverse relationship. And of course, as the equity market or as claims start to rise, notice the equity market falls. Perhaps it's the equity market we're seeing that's leading claims higher. And sure enough, it tends to do that. We're seeing the stock market come down, claims starting to rise, indicating that claims are going to go up a lot more, particularly if we see that banks are unable to buy their stocks back and they're getting concerned that the economy is headed into recession. That could take the broad equity market down even further and the unemployment claims higher. But how does that bode for retail sales? Well, Bloomberg headlines that U.S. retail sales top forecast and a boost from high inflation. But is that really the story? Value of overall purchases rose 1% in broad-based advance as furniture, e-commerce, and electronic sales posted gains. And this is the belief that you get inflation, and how do consumers respond to it? Of course, what you want, what the government wants, what policy makers want is prices to go up. That you see that, hey, that thing I wanted to buy is only going to get more and more expensive. So not only will I buy it today, but I can't afford it today. So I'll borrow the money, which creates new money in the economy and creates demand as that good or services gets bought before price goes up. And the next thing you know, it's a self-fulfilling prophecy as you get sustainable inflation. Now, in this case, we know the Fed wants to restrain that a bit, but what you're seeing in this retail sales report is, hey, consumers can afford inflation. But can they? Well, maybe not so much. The value of overall retail purchases increased 1% after upwardly revised 0.1% decline in May, Commerce Department figures showed on Friday. The figures, though, aren't adjusted for inflation. Sales at gasoline stations rose by 3.6%, following a 5.6% advance in the prior month and driven by a surge in gas prices to more than $5 a gallon in mid-June. Now, I want you to think about driving economic growth. Do people actually cause the economy to grow when they're spending more money on things like energy, in this particular case gas, or on things like TVs, vacations, and other stuff? Well, when you spend more of your income on gas, it leaves less money for discretionary spending, which is part of the reason why we're seeing inventory building. And now we're starting to see, particularly with Amazon, Walmart, Target, we're starting to see aggressive discounts because that is causing a problem. All this inventory will eventually lead to an inventory recession where all these companies will have to cut their spending. But we already know that because we've been looking at advanced new orders and we're seeing those decline as well. Let's continue on because we're going to head over to our chief strategist, Jeff Snyder, to get the real take on this. Now, if you want to know how to get his take on the retail sales report and other things on Monday, this article will be in the email. There's a link in the description below for Markets Insider Pro. It's currently free for a limited time. All you have to do is sign up, and on Monday morning at 8:30 a.m. Eastern, you'll get his report and you can learn more from the master himself. But let's take a look at what he says about the retail sales report and under his interpretation. Like their counterparts in Europe and elsewhere, consumers in America are suffering the pain of paying more and getting less. Wait, that's not the take we kind of got from the headline report. Nominally, total retail sales have increased 8.7% since March of 2021, the first month of accelerating prices, but deflating those same sales by the CPI, or the Consumer Price Index, putting them in 1982 to 1984 dollars. The implied volume of goods that were sold has fallen by 2.4%. There you're getting that inventory build story. Let's continue on with what Jeff's got to say. Is no economy, let alone one plagued by over-eager, over-optimistic retailers and wholesalers who went insane ordering goods, now clogging their stressed inventory channels, is going to hold up. When in aggregate terms, buyers have paid 9% more over the course of time to obtain 2% less of everything bought. All right, so let's take a look at where we think retail sales are going. Well, when you overlay a stock market, of course, we know the wealth effect as it evaporates, as the equity market goes lower. And a lot of people say, well, that's not going to happen now. It's going to bottom out. Remember, the Fed is pulling liquidity out. They're still doing quantitative tightening. They're still raising rates. That's going to put downward pressure on the equity market. And what that means is retail sales here in blue, both on a year-over-year rate of change, means they're going to head lower, and that's going to be more inventory builds to come. How about consumer sentiment? Well, it's in the toilet, and you can see here the University of Michigan consumer sentiment also on a year-over-year rate of change against retail sales in blue on a year-over-year rate of change. And notably, you see sentiment leads retail sales lower. People spend a bit, but eventually there's a lagging effect that hits retail sales. We know that's headed lower. That will also hurt the equity market. And of course, we've got Fed's Waller backs a 75 basis point rate hike. Says bigger move hangs on the data. An official said he's watching retail sales housing figures as traders pair bets on a 100 basis point move after comments, although I think a 100 basis point move could be in the cards for sure. It's not off the table. It's certainly on there. And if the Fed has its way and continues to hike, if you think things are bad now with the banks starting to prepare for more defaults, just wait. There's more coming. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.